Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
Good day, everyone. Welcome to Investing Insights with the Right Property Group. Here we are. It's a momentous day. Might have picked up a bit of change in the intro there. It is a new series of Investing Insights with the Right Property Group. I'm Phil Tarrant. I'm one of the co-hosts here. I'm joined by my regular panel, my co-hosts, Steve Waters and Victor Kumar from the Right Property Group. Gentlemen, how are you going?
Going well, mate. Season 3, number 1.
What do you reckon of that new intro, Victor?
I think it's pretty good. It's pretty upbeat.
It is?
Yeah.
I like it. I'm pretty happy with it.
Yeah.
I don't know about the guitar riffs. Let's see. If you like it, let us know.
If you hate it,
if you hate us, more importantly. How do people connect in? What's the email address, Victor?
It's questions@rightpropertygroup.com.
Okay. Question is, do we keep with that guitar riff or do we change it up? I quite like it personally. But Series 3, so it's we've been doing this for at least 2 years now. It's time flies. Time absolutely flies. I do enjoy it though. If you're new to the podcast, we get together once a month and we chat about everything to do with property, from buying, selling, holding, managing, financing, everything which makes a good rounded property investor. And 2 years ago when we started this, a very different market to where we are today, but you guys have been in this game for many, many years and you've seen many market cycles. And I know, Victor, you just say there's nothing strange about where we are right now.
Nothing.
We're just in the market.
Yep, that's right. It's just the cycle working. How it normally does. We've just reset to normality. We had a good run in most states, and the good run was fueled by easy finance, the buoyancy in the market in terms of consumer sentiment, and of course, the prevalence of self-managed super funds. Now, that's all starting to get a little bit more restrictive. But we shouldn't lose sight of the fact that this is just normal. This is normal. For people that have been investing for well over many cycles, this is part of your normal cycle where you get a good run and then the brakes are put on by the regulators via various levers that they pull. And this time around, they've pulled the lever of EPRA in the sense of regulating the lending by making it a little bit more restrictive. But we shouldn't lose sight of the fact that it is normal.
So we've covered this a little bit over the course of the last sort of 4 or 5 months. So go and have a look at the most previous episodes. We dig in depth around markets and how, as property investors, you can capitalise on the current market conditions. And today, what I want to do is, here we are at the end of November. Everyone's sort of already thinking Christmas party mode and what they're going to be doing over the summer and taking time off. And I often use this period of time to slow down a little bit and think about the next year and how I'm going to be approaching my property investments and other stuff moving forward. So it's a good time to reflect and just do a little bit of strategy and planning. And that doesn't need to be too formal. It could just be musing to yourself when you're sitting on a beach somewhere. But I thought what we do today, guys, is have a look back over 2018 and looking at the key factors that we've seen, some observations, some analysis of the market that was and how that might help people shape their views towards investing in 2019. Steve, for you, I know you, both you and Victor, you're very fortunate in that you live and breathe property every single day. So I'm a bit of a part-time property person. I sort of jump in, I jump out when it suits me. And suiting me typically is drivers around how I balance business with personal life and property, right? There's 3 sort of very big sort of pillars amongst other things. So I'm in and out, but you guys live and breathe and you every single day are chatting with property investors, very sophisticated investors with huge portfolios through to first-time investors. So you guys get a really good read on the market. And that's why this podcast is so valuable, because we actually get some real inside info on the mentality and mindsets of property investors right across Australia. So let's have a look at 2018. When you think back of this year that's just passed, what would be the sort of the key observation you would have towards the property markets and property investing?
That's a good question. It was only the other day that I was reading through some blogs that I'd written earlier on in the year and some commentary to various people. And the beginning of the year I said, or the end of last year, beginning of this year, I said, this year is going to be all about finance. This is going to have a heavy effect.
And you wrote this back early in the year, okay?
Yeah, or late last year, whatever it was. Yeah, but we were talking about this year. And it was an obvious thing that was going to happen. In fact, the levers were already pulled probably the year before. It just that the effect was, or the momentum of those levers being pulled hadn't yet taken effect. And as a result of that, and finance becoming so much more difficult, then we started to see consumer confidence erode, and we started to see that certain markets peaked, being Sydney and a little later in the year Melbourne. And as a result of people's wealth being eroded on paper in the Sydney markets especially, that the consumer confidence started to ebb away very, very quickly, and that's where we are today. So this year was all about finance, and it will be next year as well, but maybe that'll be the next podcast.
Mm-hmm. So was there a point in time, Victor, for you where you went, the market has now changed? Was it, let's call it a tipping point is what it is, where markets go from rising to falling? And we're talking about Sydney, Melbourne in particular. We'll touch on Brisbane and some of the other markets a little bit later on, because there's been some great places to invest over 2018.
Absolutely.
But for you, was there a tipping point? Can you remember back over the year just past and went, it's now changed. Things are going south rather than north.
I think it's more of a gradual thing, right? So little bits and pieces add up, and then you realize that actually you are in a flatter market than a more buoyant market. Obviously, my budget was a point that you could tag back to, and consider that a lot of people were waiting to see what the budget was going to bring, and then realize that, hang on, it's just business as usual. There were just some small changes that have happened at that point in time in relation to property, unlike the previous year. And when you look at it from a viewpoint of most people sitting with their accountant in July, August, there was and there usually is a natural slowdown in terms of investors, because they want to sit down with their accountant before they regroup, and then there's usually a surge of property investments in September, October, November, and that still came through, except the types of properties, the strategies that your sophisticated and savvy investors were trying to get to has changed. So it's no longer let's buy something. It's more like let's buy something pertinent.
Well, I think also the big key there as a result of that is that the FOMO investor has left the market. So those that just, I've got to buy something.
What's a FOMO investor for us who aren't sort of au fait with the latest cool jargon that the young youth are using, Steve?
Is that the best you got?
No, I'm just starting. Or does everyone just know what FOMO means these days?
It's just fear of missing out. So a lot of the market was being perpetuated to a certain degree from people that just wanted to invest. They just wanted to buy property because they had seen the tremendous results that everybody else was posting on Facebook or whatever it may be, and the newspaper headlines or all media headlines for that matter. And so they just needed to get in, and to get in, they had to often pay more than what the property was really worth. And there's a difference between what it's really worth and what someone bought it for.
I think you mentioned something really pertinent there about Facebook. And if you look at it look at this cycle as compared to the previous cycles, the catalyst in here is actually social media. Because we are living our wins, in inverted commas, through Facebook and through our social media, and therefore everyone seems to be having a win, and it becomes that herd mentality.
No one loses anymore.
No one loses anymore.
Well, nobody wants to talk about the mistakes or perhaps things that didn't work, and any of the numbers that are put there are embellished to a certain degree. And I agree that any social media platform, and we've said this before, is a big reason or a big part of the overall picture as to why this market did perpetuate as well as it did.
So Steve's identified 2018 as the key theme, year of finance. Mm-hmm. Do you agree? Is that the key theme, or what would you add to that?
No, absolutely. Finance was the key thing, because a lot of investors that have started just in this cycle were used to getting finance really easily. And now that the finance is a lot more harder to get, it's not impossible. And in fact, a lot of people, when they're reading these media articles, they're thinking they will not be able to borrow. And I'd say that go and sit down with a broker, map out your options first before you decide for yourself whether you can get finance or not. Yep. So that's been the biggest change, and it's helped reshape the market as well, in the sense that a lot of people, say in Sydney and Melbourne, are now chasing the lower entry point and higher yield in different states. And quite a few of them may also have then gone down a path of abandoning fundamentals and buying in areas where it may not have suited their financial footprint. when you really look at it from a long-term point of view.
So this is an important point, Victor. And Steve, if you can explain the relationship between strategy and market forces. So what I mean by that, picking up what Victor said, you had people in the Sydney Melbourne market who at a point in time might have been pitching at these properties of sort of $700,000-800,000 is where they were buying. And because of limitation of finance, the theme of finance for 2018, they've changed their strategy and they've moved into different types of assets, which are more affordable assets, a little bit further out of the city. You know, it's quite a complex sort of dynamic that's happening. So if you're one of these investors who have fundamentally shifted your strategy because of finance from this year, is that a good thing? Is that the right thing to do? Or are you better off sticking the course and waiting for financial markets to return?
I think there's calls for yes and no to answer that. Like if you have the financial awareness and the ability to be able to control a certain price bracket asset, let's call it that, and it's produced the results for you, and you're comfortable with it, and we'll throw some fundamentals around that, being that they're in well-located areas and what have you, then stay the course. At the end of the day, it's all about cash flow. So it's not just about the property's cash flow; it's about the household cash flow as well, and how well you can manage all of it and all these mechanisms and mechanics and put it together. People choose strategies for certain reasons, and not all strategies are created equal, and not all work, but there are a heap that do. It's just finding that strategy that suits your risk profile and your financial footprint.
So I've always been very pro buyer's agent. I always use buyer's agent for my properties. I use you guys. You guys haven't changed your strategy and the application of your strategy at all because of the current financing market. No. There's a couple of tweaks, but fundamentally it's the same thing. You're still acquiring the same type of assets. They're just in different locations. So if you're tuning into this and you're thinking, oh, yeah, my buyer's agent sort of changed the way they've told me to invest because of this current finance market, is that okay? Or should you be sitting there thinking, oh, why has this shifted so much? Or is that really is that good advice from a buyer's agent to shift what they should be doing?
It's a good question. I think it depends on the circumstances of not just the market, but that person's, where they're up to in their own journey in terms of their portfolio or their future cash flow. The buyer's agent may have already had in plan that they're going to shift direction and take advantage of perhaps opportunities that present themselves. But as long as the fundamentals are okay, and even coming back to us, whilst we do purchase a lot in the affordable areas, I think the mistake people think about us is that, well, we just buy the cheap stuff, and it's not that. It's about affordable to that area. So if I can go down the road here at Point Piper and buy a property for $800,000, well, that's affordable for that area. Yeah. So it's just understanding the dynamics of the strategy and the property type and the price bracket.
So just crystallise your strategy, Victor. And I've known you for 5 years now, I imagine.
9 years.
Maybe a bit longer. It's not that long, is it?
Yeah, it's been quite a while.
God.
Yeah.
Okay. There's a...
He's obviously enjoyed the time.
I know, right?
How'd that happen? So the fundamentals of property, and we chat about them all the time on Investing Insights of the Right Property Group. So, go and listen to that stuff. There's oodles of podcasts around that. But can you crystallise this fundamental strategy about investing close to local economic areas? So a lot of people think investing in property, you need to invest within 10 kilometres of the CBD. Yes. So in Sydney, that would mean Chatswood, Strathfield, and you're looking at $1 million plus there. But Sydney's a big city, Melbourne's a big city. So, the same logic of investment, irrespective of the location and sort of, I guess, satellites, stands true. Can you just sort of give some insights into that? Because a lot of people, when I've heard you talk about this before, it sort of flicks a switch and they get it.
Yep, absolutely. And I think the first thing to point out is that you've got to adjust your strategy in terms of the distance from CBD that you're buying in line with the population in that state. So as an example, Sydney, as in New South Wales, we're talking 8 million, almost 8 million population. Melbourne, we're talking about 6.5. And Brisbane, we're talking about 3.5. Yep, and therefore the distance that you're buying from CBD, so the main CBD, which is postcode 2000, 3000, 4000, you normally want to be adjusting it in terms of travel distance via public transport or private transport. So if I take Sydney, I'd probably go hour and a half max. Melbourne, I'd probably go 1 hour. And in Brisbane, probably within that 45 minutes to an hour, depending on which direction you go. Once you've identified that, then you need to obviously look at your micro CBDs or the satellite CBDs. So if I'm talking, say, as an example, Sydney, You're talking your Parramatters, your Campbelltowns, your Blacktowns, your Gosfords and all that. So they are your CBDs. Because the way our employment has been structured has changed substantially. And in fact, if you look at the Greater Sydney Plan, by 2036, the plan is that every person living within the metropolitan area, and the definition of metropolitan is within 1.5 hours from postcode 2000, is going to be within half an hour travel distance from their potential employment. Overlay that with the fact that we've just gone through a change in terms of how we are employed. In other words, we are able to work remote via technology. So that's allowed us the urban sprawl and being able to work from home, work from a satellite office, and in fact having the offices or headquarters in different suburbs. You've got this perfect storm happening where you don't need to be within 10 minutes or 10 kilometers of postcode 2000. You need to be within 10 minutes of that CBD. So you've got to realign the definition of CBD, because that has actually changed. And you need to then obviously adjust it for each state.
I think that's a really good point, because a lot of people will say, well, you need to invest sort of 10 minutes, 20 minutes maximum from the major postcodes, 2,000, 3,000, 4,000, 5,000, what have you, because that's where the land is at its most scarcest and the demand is always there and prices will go up. And that's true. My only caveat to that is it will always only house a certain percentage of the population, and that certain percentage of the population is the smallest part of the population because purely because of scarcity, and not everybody can work in the cities. So these other metropolitan areas, or these cities we'll call them, that are outside within the hour, depending on the state, actually show great growth, and proof's in the pudding, history's there. And then you overlay that with the fact that they're not making any more land. And I know that's a well-used cliche, but it's the truth. If we talk about Sydney, you're bound by mountain, sea and national parks. So people have to have that urban sprawl is just going to happen more and more and more. The caveat to that commentary is if we went to somewhere like Adelaide.
Yep.
So Adelaide's a different kettle of fish, where we advocate buying sort of 20, 25 minutes no further from the CBD. If we push it, it's there needs to be a good reason. And
that's because of the population pressure as well.
And because of the open space and green fields as we talk about it. And even if we come back to Melbourne, and where people are saying, well, listen, invest closer to the CBD of Melbourne, 20 minutes out, because anything further than that, and this is tongue in cheek, but any further than that is regional, just doesn't fly with us. Because if you take Geelong, you take Melton, you take Ballarat and Bendigo, where people naturally moved away from the CBD areas like they do in every other state because of affordability, because not everyone is going to be able to afford 1.5 million plus or thereabouts, then it's just natural that they look for something where they deem is value. And as a result of that, supply and demand kicks in once again. But Melbourne is a little bit different because they do have a lot of green space between what they classify as regional. So let's talk about Geelong and back into the CBD. So it is a matter of being very deliberate and making sure your research is spot on.
So if you look at it from the viewpoint of in inverted commas, the boom, right? So the previous years it was fueled by the industrial boom. So we had industrialization. So in other words, if I come back to Sydney, most of the factories and the work was close to the CBD. Now we've diversified out. We've got satellite centers, and that's where everything happens. Then followed the technology boom, which was the ability to work remote. And now the new boom that's coming in is your infrastructure boom. Australia at the moment is spending probably the most amount of infrastructure dollars in the developed countries. And this is something that, whilst we don't want to speculate on what can happen and what will happen, we want to just follow the fundamentals of how things are panning out. And if you look at Sydney, Melbourne, Brisbane, they're fairly significant dollars being spent in terms of infrastructure. And if you overlay that with the normal fundamentals that we advocate, you can't go wrong regardless of where the property cycle is, so long as you adjust the type of property and the strategy that you're undertaking to be in line with the property market itself.
And this goes back to adjusting your strategy on market forces, market conditions,
Yep.
and market conditions is government infrastructure spending, huge.
Immigration,
next level. Sydney, Brisbane, Melbourne are big global cities now, and you have a very changing environment. The emergence of Asia, and let's remember where we're based here. We're firmly within the the Asian community here, and Australia's going to ride that wave over the next 20 years. Difficult security environment, and that's going to change things as well. But Australia will firm itself, particularly the East Coast, as a backbone of the developing Asian nations. That's a great place to be. So that's a big thing, right? Australian government sees it, they're spending money. State government see it, they're spending money. But we still have this finance situation, which is, the big theme of 2018. And let's remember where we are with finance right now is not by accident. It was a deliberate regulatory mechanism has been put in play to shape our financial markets and our property markets. And we've spoken about this beforehand, but APRA, regulatory bodies, made recommendations to banks and requirements on banks to change the way in which they lent money. And that was three or so years ago, isn't it, Steve? So it's taken that long to really...
The effects
to
only really
play
took
out.
place maybe late last year, but certainly this year, and then you overlay that with the consumer confidence piece and what have you. But what APRA did was necessary, and I actually, everyone involved have done a pretty good job. I believe they've stopped this bursting effect of the bubble, so to speak, and it's been and will continue to be a soft landing in certain areas.
What's soft landing mean?
Well, we just don't have this GFC overlaid recession depression scenario.
Because things are good.
This is the thing that
things
kills
are
me,
good.
because if business confidence and there is an indicator, and you can Westpac put one out the other day. Business confidence is high. Consumer confidence is relative. It's taken a bit of a hit, but that's all around about the household wealth or the wealth between people's ears because of household or their properties. Jobs growth is good. Underemployment is still there, and essentially, just in very layman's terms, that's the people that want more, that are part-time employed and that want more employment or full-time employment. Our inflation is still low. There's which is not a good thing either. It does need to be in that band, but it is not doom and gloom. And whilst there's a lot of clickbait media around at the moment saying the world is falling apart, I mean, whatever it is, whatever you think it'll be, you'll find the supporting information for it. But at the end of the day, and I know this has been talked about so much, Australia is not one property market. There's markets within markets and so on and so forth. We know that. But people need to take stock. They just need to stop, have a look at their own fundamentals, and that could be, well, when was the last time that you got 3.88 interest rates? Admittedly, P&I, never. When was the last time that you were getting 4.5s or 4.75s? Yeah, it's been around for a few years, but if you go back, and these are the people that hadn't invested before this cycle, we're used to paying six and a half, even 7%.
That's what it was when I started investing.
Yeah,
it's 6.5.
And the big thing that the media is not talking about, or the clickbait people, and whilst property prices have fallen, and they're talking about 20%, 30%, whatever it may be, and I think we were talking about this beforehand, that there are some parts of Sydney that have fallen by 20% already, no doubt. There are some parts that have only fallen by 5%, and there are some that haven't dropped at all.
Some's going up.
And there are some, if you look at the data, they may have even increased, but the truth behind the data is a little different. It's not that bad. If we just do some really simple maths, and I'm going to be very general here. So over the last 5 years to the beginning of this year, we've had 75% growth in Sydney. Yeah, that's awesome. That's cool. And now we've come back. This is just for my maths' sake and over-exaggerating in the negative way. So we've dropped by 25%. So that leaves us 50% over 5 years, which without even compounding and all that sort of business is 10% per year. If I had have come to you 5, 6, 7 years ago and said, let's get into a Sydney market because we're going to get 10% per annum growth, you would have fallen over yourself to get in. It's not that bad. We've still achieved 10% growth per year. We are getting back to normality. The people that are going to suffer are the people that are bought at the top of the market. They are going to suffer.
And over-leveraged to do so.
And over-leveraged.
Because lending conditions were a little bit more favourable a year or so ago.
Correct. Yes. But their saving grace, if they've managed themselves well, is that the cost of money is very, very cheap. Now, there's a potential for rolling over into P&I and so on and so forth, but even that's at a cheap rate. Yeah, they need to take steps now. I just don't buy into this scenario that the world is falling apart.
And also, what you painted there is that property price growth doesn't move in straight lines, does it?
No, it doesn't. It never does.
You look at XY axis and property over time. Most people just see this line going up from 1980s to where we are today. It's just
it's not linear.
It's not linear. It's up and down.
Yeah,
and that's what market cycles are.
And another thing that I picked up on what you just said, Steve, when we're talking about the 6% and 6.5% interest rate back in the previous cycle. It's all relative because at that time the yields were 7 and 8% when you're talking in the markets that we were investing in. So if we forward pace that to now, we've got interest rates of 4.5%. Our yields are 5.5%. So the only thing that's really different is the price point. In other words, how much it's going to cost you to enter the market. That's the only thing that's really different. And therefore, that's where you need to look at your cash flow because you're then chucking in a bigger dollar amount per week to hold the same property because you've bought it at a higher price.
And and then even going further from that, if rates go up, well, rents will go up. That's just not just a simple flick of the switch, but there's a lot of mechanisms in play that would suggest that the housing boom that we are having, and even those that are still yet to be constructed, will stop because the developers can't get funding because they've got no pre-sales. And this is once all the immediate stock has been absorbed. Immigration still happens. Population growth still happens. So here's a long prediction. And everything in real estate's long, but here's a long prediction.
Are you gonna pin yourself on this? Can I bring it back up? All right,
I'll pin myself on this.
Here we go, Victor.
I'm not going to give a time frame because we are going to go back to what we were post GFC in terms of
I agree.
Terms of the supply and demand situation.
And what was that?
Well, the reason the property prices really started to percolate after the GFC was because all construction stopped during the GFC because of no finance, no pre-sales, so on and so forth. But once again, population kept happening, immigration kept happening. It was all the right fundamentals. So it lurched from being perhaps just like we are now into an oversupplied situation in some markets to an undersupplied situation in most markets. And
which is your normal property cycle.
So can you just explain it? So undersupply meaning there's not enough properties for sale compared to people that want to buy properties. Is that undersupply?
There's not. I actually wasn't. Yes, but that's what I wasn't referring to. I was actually referring to rental demand. So there is more people that want accommodation that is available, and as a result of that, then rents go up.
Yeah,
and it will happen. This is just history repeating itself. And if you want to then overlay the whole negative gearing scenario with if Labor gets in and all of that sort of business. Will that be bad for the economy? Like nothing else. And there's been enough commentary around that, so we won't go into it. And I'm not saying that just because I'm the property guy. It's just common, basic economics 101.
Hopefully, sensibility will prevail, and I think there's probably enough pressure there.
But there's a part of me that kind of says, I hope it does happen. Is that a bit weird?
It's bargain time.
Yeah.
Look at you guys, just out there always looking for bargains. I guess that's what you do, right? They're finding great properties under market value, right? So,
well, it won't affect people too much like the types of properties we buy because we're not gearing relied.
True. And I guess where you guys secure assets for your clients are in the affordable belts, and if investors come off because of a negative gearing situation, first-time buyers, and that's increasing as it is right now. So it just puts even greater pressure on for properties 100%. In that price point. This goes back to the supply and demand scenario.
And it is that simple. And I think too many people are trying to complicate it, and there's so much data out there and there's so much rhetoric that is confusing the consumer and maybe quite deliberately. But if you just break it down to the real basic form of what it is, this is a normal market. This has gone back to normality. Anyone that just thinks this is normal hasn't experienced any other market. And therefore,
so what was it before now then? Exceptionally different, was it? So if you look back and this is what's happened in 2018, and I would identify 2018 as a revert back to normality. So it's just part of a cycle, right? But
correct.
So what was the last 3 years? Was that just like, oh my God, what's going on here? Because that wasn't
normal.
That wasn't normal.
No, and so we were only talking about this the other day actually because how long was it ago that we stopped buying in Sydney?
3 years.
3-4 years ago. And we did it quite deliberately, even though we knew that there'd still be a run on
So let me get this right. So when you guys pulled out of the market, property started going down.
No, they kept going
You
up.
guys have, they went up for about another year and a half, right?
Yeah, well, maybe even long, probably 2 years. And we got out quite deliberately. I mean, we could have sat back and said, let's keep buying more and we'll ride this equity train. But we knew that it was going to retract.
Have you done the math yet? So can you go back? And I'd like you to do this for me. When you guys exited the city market and stopped buying, obviously it went up and it's come back down. I'd like to see whether or not when you exited the market, whether the city market when it comes to its bottom is at that point when you stop buying. I'd be really interested for you to run that scenario for me. Does that make sense?
You know what? We're already in the throes of doing that.
Yeah.
But we're actually going to go a little bit more because we want to see what that growth was. If we pulled out at a price point, let's just call it 400,000 for maths, and it got to 600,000. I mean, some people would say, well, look at you guys, you're not that good. You missed out on $200,000 more growth or equity. But because we've seen this time and time before through multiple cycles, we knew fairly well that if we got out at that price point that the market would still perpetuate and there would be some haters, and we get that. But we also knew that it'd contract because it was too quick, too soon. And that contraction point back to that dollar amount is the figure that you're talking for. And we will have that.
I reckon it'd be really interesting. When you've got that, let's have a chat about it. And we've got to wait until when are we going to signal the bottom of the city market? I don't know.
It'll have to be after the fact because no one can actually predict that.
No one can
right?
predict it.
It needs to occur.
Yeah,
And
it's
then
probably a year or two away before we can actually work this out.
But it happened like we did the last cycle, same thing. The cycle before that, same thing in different states.
So let's chat about that. So this is 2018 is all about finance, right? But if you secured property in Sydney at the point in time when you stopped buying, as in you went, that's it, and at that price point, buying the right asset with the right upside value over time, and it might be a bit of an X factor or whatever, but the yields are good. So that's sustainable investing, isn't it?
True.
Right. That's exactly the definition of sustainable investment.
Yep, that's the point. And because you haven't over-leveraged yourself or used more capital or got a higher loan amount if you're purchasing, with the potential, which has now come true, of rents actually contracting, because that's what does happen in a rising market. Most people think that rents will stay in line and run parallel to the growth curve. It doesn't. The rents actually contract while growth happens because there's more accommodation.
And my portfolio is a case study. Now, I remember when we bought stuff out, say Mount Druitt Way.
Correct.
2 years after buying it, the rents come off probably $20 or $30, and have stayed there.
Let's use that Mount Druitt property.
Let's talk about Luxford
Road.
Luxford Road.
So that got as high as probably on the open market during the actual heyday and when things were just fizzy. You could have write your own price on that 2-bedroom unit. You had probably 380 more.
Yeah.
It just got silly.
Just went crazy.
So imagine the investor that bought it at let's call it 380. And we're only talking about an old red brick unit here that had a haircut and a shave, so to speak, opposite Westfields. So if you purchased that at 380 and you're getting 320 a week rent?
I think so.
Yeah, 320 a week. So straight off the bat, you are negative. And let's imagine that you got a 90% loan on it because that's the whole reason we are where we are.
Yeah.
Now the property's probably worth, I don't know,
340, 320?
probably even a little bit less. So it's come down a little bit more. So now you're in a huge negative equity position. You're still riding massive negative loss on the property pre-tax. And you're stuck. You're
going to have to carry that for at least a couple of years.
Well, here's how it works. So if we go back to where I was talking about if we break it down, it's been 10% per year, just for my simple maths. This happens because, and if the average is really probably between 6 and 7 Australia-wide as terms of
growth.
Yeah, growth since Captain Cook got here or thereabouts, then that same person that bought that Mount Druitt unit at 380, not only have they just contracted in price by, let's call it 20%, but they're also in for a no growth market for probably 5 years because we need to get back to the averages. It will just naturally get back to the averages. So he's stuck or she's stuck for 5 years. And this is the importance of when you have a market like Sydney that has done well and you've been very deliberate in where and how you've purchased it and when you've exited the market and then where you've moved that equity on so that you haven't over leveraged. Different markets give you the best opportunity to diversify.
And I'm really conscious that we, a bit of a case study there in the Sydney market. We're just not Sydney centric. We're talking about the same thing happens in other markets: Melbourne, Brisbane, Perth, Adelaide. At just different stages, different cycles, different nuances, different reasons why they're happening. But typically, irrespective of the location, property markets run in similar cycles. They're just at different times at different places. So 2018, I agree with you. You're a finance. If I had to recap it, another couple of things though I'd identify with 2018 would be is sort of negative media sentiment. I think, and I don't want to dwell too much on this because I covered it beforehand, but
didn't it happen quick?
It did. The role and the obligation of the media. I remember reading a year ago, property's booming, what a great asset.
How to make a million.
And then literally a week later, oh no, the market's fallen to pieces. So,
But we told you so.
But we told you so. So my point on this would be, and you guys can fill in on this, is that sometimes just don't listen to the media. It gets over sensationalized, and be careful where you get your information from, is what I'm saying. I would identify 2018 as part of that, because it's topsy-turvy. You read the media, it's topsy-turvy, feast and famine, one day to the next.
But it's also because of social media, because that's the greatest
Absolutely.
and easiest platform for the media to get their articles
But
out there.
if you dial back to the last cycle, so just before the GFC hit, right? Obviously, that was a big bump on the road, right? But you still had similar headlines back then. And in fact, if we talk about the affordability factor, and Steve, you and I were doing a reno, and we found some old newspapers under the carpet, and it was back from 73 or something like that. And
Same headline.
Same headline. Affordability.
Yep.
Yeah, it costs $30,000 to buy a property
Exactly.
now. It's everyone's priced out. I saw something very similar from the 80s a couple of days ago. Exactly the same. You could have just changed the date on it. Exactly the same.
Yeah, so it's
headline.
not new. It's not new news. This is just history repeating itself. And if you stay the long term, you'll be okay, as long as you control your cash flow and all that sort of good stuff. It's
And if you're buying at the top of the market, you just got to make sure that you are able to afford to hold on to that particular property without compromising lifestyle until the next cycle pushes it up again.
Yeah. So another theme I would say, and this isn't a primary theme, but just something I see from my vantage point, Stephen, it's the evolution to, I guess, the mindset of investors to embrace advice. I think that's something I've seen over 2018. I've seen a lot more buyers agents come into the scene, and I think that's good. It's
a great
for the
thing,
industry.
yeah.
You guys have been at this for how long? Yeah.
2004.
2004. So you've been doing this for a long time. You've got a lot of experience. And you're seeing an emergence of buyers agents coming in, and I think that has to be driven not by buyers agents going, oh, let's become buyers agent. I think it's from the attitude and aptitude of consumers, as in investors, to actually embrace advice. And I think that's a really important point.
It's a great thing, and I think as time goes on, I hope via certain platforms such as media, such as Pippa, that the industry does, and we've talked about this before, that it does become regulated so that not anybody can just start dishing out advice or hang their shingle as a buyer's agent or real estate agent or whatever it may be, or a broker for that matter. That the advice that you get needs to be in line with your goals, firstly, and that the advice that you get is tailor-made to your situation, not just a shoehorn approach, one strategy fits all.
And look at who your advisor is and what's their history in terms of how many market cycles they've seen. Are they actually living and breathing the same strategy that they're advocating? So, making sure that you are using their market knowledge, their personal experience, so that you don't have to repeat the mistakes or make the mistakes that they've done.
And I think
I agree.
Yeah, I think it's really important though that everybody starts somewhere.
Yeah, absolutely.
Yeah, so even a buyer's agent, they got to start at some time. When we first started, like we've been investing since 2000, 2001, buyer's agent since around about 2004, thereabouts, give or take. I had to start somewhere.
You've got to start somewhere.
Yeah. And I get that. But I just think in today's age of technology and the amount of advice that's out there is probably where the problem is as well.
Don't drown in the information.
Don't drown in the information. I think having watched you guys within the buyer's agent space for many years now, the new breed or generation of buyer's agents coming on board, you're the sort of business they all look to emulate, right? But, how do you can't trade off experience and time in a market. You guys, your observations going, yeah, we're back to normal. Because you've seen a couple of market cycles. And that's the important thing about advice. And that sort of goes from also being a buyer's agent to being a property strategist, which are two very different things.
That's where the experience comes in.
And I think only when you've seen a couple of different markets that you can actually start being a property strategist, because you need to actually know that depth.
We don't want to bag everybody else out there, because there's some really good
Some great.
operators
There's
out there.
some other great people like you guys who have that same,
Absolutely.
and they're the guiding light for this industry. You know, I think it's a very good thing.
Yep, and it's just I think you said it, like drowning in information. There is just so much information out there, and Google's as bad a platform or as good a platform, whichever way you want to look at it.
Trust your advice, trust the information you receive.
Yeah, but it's also you need to seek counsel. There are multiple team players in your journey. If you take us as strategists and buyers agents, then there's your accountant, then there's your broker, and if need be, a financial advisor. Yeah,
inverted commas.
Inverted commas, yeah. So that
no one can see it.
I'm tough like that. These all play a crucial role in your journey, in your business plan.
So this is good. I'm going to go a little bit longer today. It's the first episode of Series 3. So I'm going to take liberties and push this a little bit longer. We've spoken about 2018, year of finance, completely agree, and we've sort of broken down some of those issues and concerns and how that's influenced market dynamics and the way in which you buy. We've covered some of the other themes associated with around media and trusting information you receive, the growing enhancement aptitude of property investors to embrace advice. Really, really good. That's all cool. Let's put that to one side. What I want from you guys is 2018, considering all these different changes in the market, the different nuances and mechanisms underway and how things are changing. What are the best 5 things you've seen property investors do under this sort of market conditions of 2018? Steve?
Why do you go to me first all the time?
Because Victor's sitting there thinking. So I know he's going to give me a much better response than you. So I thought I'd give you the first one, which would probably be quite a soft response.
I don't have to do all 5 straight away.
No, you go first. Over 2018, the best investors you've seen in the market, what have they done? What's been the tenets of them being successful in 2018?
Short answer, cash flow management and liquidity. Well, that's kind of the same thing as well, because they've taken it seriously. They've been able to track their portfolios. They've seeked the right advice, but they've also been invested, and that means time, into their own numbers. So whether they've come up with it by themselves or whether they've taken counsel, they've kept their cash flow clean and lean. They've got adequate buffers in place in terms of cash flow and capital, and they are waiting for the next opportunity.
Okay. Victor, your second one?
Yeah, absolutely. And one of the things that I'm noticing more and more is that we're starting to become borderless investors. We are looking at emerging markets. We're not just, if we're in Sydney, we're not just investing in our own backyard. We're actually able to go to the next level and look at interstate investing or investing in other suburbs in that state. That has been made possible through several reasons. The first reason, obviously, is whilst I bagged social media earlier, that's the pro of social media, is the education platform that it provides has been far better, and therefore you're no longer investing and educating yourselves by books that may become out of date really quickly, or is pigeonholed into a particular strategy, such as a tax strategy. In that sense, we're no longer investing by looking at articles in the newspaper or reading articles in the newspaper. We actually actively educating ourselves using webinars, using podcasts like these, and therefore our scope and our ability to invest, because the mindset and the education has changed. I'm seeing that there are a lot more investors out there that are getting into multiple property ownership without compromising their lifestyle.
Okay. The third point I would make around what the best investors have done in 2018, and I would say not buy. There's been a lot of people that have the confidence and the sophistication to go, you know what, I'm happy to sit on the sidelines.
Yep.
And wait. Sort of connected with your point around having good cash flow management and know your situation, but they don't feel obliged or pressured to buying when they don't think it's the right time to buy.
They're not pegging themselves against someone else, which is really, really
so
important.
That's some of the best investors I've seen have had the confidence to make that decision. Fourth point, Steve, what the best investors have done in 2018?
I go to 5. I'll come back to 4 in a minute.
What's fifth then,
Look,
Vic?
it is actually adjusting the strategy, right? So I'm starting to see, and actually I'm also recommending to a lot of my my clients, is to go down the route of creating that value. So as the market changes, we are starting to see more and more of the need to create that value to protect your deposit. So your renovation type of properties, your value add properties are now starting to become more prevalent. And I'm starting to see the definite shift of people now no longer just going for your pristine properties or your off the plan. And again, coming back to my previous point, it's all coming back to education and better awareness via our clients. And if I can throw in one thing that's changed in 2018, which was more so towards the end of 18, so right now, is the ability to buy properties within your self-managed super fund, because a lot of lenders have actually come out of that lending space. And it's a bit of rationalization within that. And I think what it will do is actually ease the pressure in terms of the competitiveness of buying property, investment properties out there, and allow us to then come back to normalcy.
And that's a good point, because we actually talked about that late last year and early this year as well, saying
watch this space.
Watch this space. As you know, it will cease to exist.
Okay, round us out. Give us a fifth point.
Number
Steve.
5, I'm going on with the SMSF theme or thereabouts. I think it's really cool that people are actually thinking forward. And once again, thanks to probably social media and the various platforms of education. And what I mean by thinking forward, they're actually wanting to take control of their own future. And we're fast forwarding or looking way into the future now. So not being reliant upon government, not being reliant upon the small amount of super that they have. They want to actually take control, whether that be property, shares, bananas, whatever it may be, and not just via SMSF, but they want to do something for themselves rather than sitting back and just waiting for something to happen, which is pretty cool. Wish it was around when I first started.
That's true.
So I'm going to extend a little bit longer. I've got a new section for us, which I thought about this the other day, and I've done some research and gone through the back catalogue of all the questions that you've received over the last couple of months, Victor, and I'm going to do a question of the month.
Interesting.
And I've chosen this particular question because it's sort of connected in with our conversation today around finance, and it's from Madeline East. Madeline, thanks for writing in. We will get you to your questions eventually, so please make sure you send your questions through to Victor.
To questions@rightpropertygroup.com.au.
And I'll summarise Madeline's question here. She pretty much asked, I'll direct this to you, Victor. She's asking about what lender she should be choosing in the current market to secure investment properties. And she did a bit of a preamble, said she's got 2 investment properties and she's got a place in Sydney and in Brisbane. But she's asking, which lender do I choose? Do I choose a major bank, considering all the hullabaloo that's happened around the Royal Commission, still yet to wash through? Or should she be looking at maybe a second tier or a non-bank lender? Or does it not matter?
Can I qualify this first to say that, go with a lender that'll give you the money at the best rate possible? Based on your circumstances. But there's several other things that play over here. One of the things could be that if you're going with a, say, third-tier lender, you sort of got to question why you're going down that path. Nothing wrong with third-tier lenders.
What's a third-tier lender?
Yeah, so like third-tier lender, so it would be
don't know names. Yeah.
non-deposit taking institutes.
Okay.
Yeah, so they're not your major banks.
Yeah.
And if you are with that lender, and let's say you can't borrow any money but with that lender, it sort of constrains and makes your portfolio and your situation not as liquid. So if you then ran into trouble down the track, or if you had a change in circumstances, your only option then is to sell out of that property. So you got to take that into account before when you're looking at the lender. And I think in today's day and age, you have to also look at a lender that has got good internet banking as well, so that it's an ease of transaction. And looking at your fees and charges that are they're not just focused just on the interest rate. Look at all the fees and charges that they're implementing, and compare apples with apples that way, rather than just going with a name or a brand name, or going with institution that you've always done your banking with.
It's a good question, Madeline. Good thought process. My recommendation would be go and speak to a good mortgage broker, and they'll have a good look at what you can borrow and make those recommendations. Mortgage brokers are worth their weight in gold, so lean on them and they should be able to help you out. Guys, I think we've done a pretty good job there.
I think we've done really
Yeah.
Well.
Yeah. Series 3, episode 1.
That's a wrap.
That's a wrap. And we want this to be a bit of a journey, so it's just not us formulating topics every single month. We'd like you to help lead us and guide us about the type of stuff that you would like us to discuss on Investing Insights of the Right Property Group. Victor, again, questions at rightpropertygroup.com. Is that the best way to reach out? Facebook posts?
Yeah, you can private message us on our Facebook page as well, Right Property Group, or reach us on that email address.
And if you're after any other types of education, go to the website. There's videos, there's blogs, there's
a
ebooks.
lot of free resources there.
Yeah,
No
over
shortage
100
of stuff.
Yeah, over
Is there anything we
150
won't
articles.
cover? We'll be happy to take on anything.
We're happy to take on anything.
Property related.
Property related.
Yeah. Talk about your holidays.
I don't have holidays, mate. I'm too busy working to try and make some money to buy some property.
and the other thing is we'll have a webinar out that'll be out in the next couple of weeks. So stay tuned for that. Look for it on the socials, on the website, or wherever else that it'll be talked about, and make sure you register.
Cool. All right. Well, thanks. I really enjoyed that, gents. So it's a long one. It's sort of 50 minutes. I think it's an all-time record. So let's not set the benchmark at 50 minutes for each episode. We'll go back to our normal sort of 35, 40 minutes moving forward. But you know what? That said, if you're happy to tune in for this long, we're okay with the feedback. And if that's what you want, we're happy to deliver. So thank you. Really enjoyed it. Onwards and upwards for next year. So our December podcast, we're actually going to look forward rather than backwards.
That might be about predictions.
Yeah, some predictions on what's going to happen. And you've made some predictions already, so let's see if they play out.
So do I have to come then?
Maybe. You've done your job.
Yeah.
Victor's
I'll have a lay
Victor's
down.
a talent here. It's like, you can wear a different jacket next time, though. It's a shame. Well, maybe we get a photo up there. I'd like people to get some feedback on that thing.
I've already had feedback.
And what they say?
I loved it.
Oh, really? Okay. Well, there you go.
They're just being polite.
Fashion forward. Anyway, thanks, gents. Really enjoyed it.
No style.
Thanks for tuning in, everyone. We'll see you again next month. Until then, bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.